Hello and welcome to Options Guy TV. My name is Brian Overby, the author of the Options Playbook, and I will be your host for about the next 30 minutes here on Options Guy TV. Well, we have a lot going on right now. The markets are down a smidge. We see the S&P 500 index down about 1% at this point in time. JP Morgan came out and struggled after their earnings report, which was interesting because they announced they beat on the bottom line and revenues were weak, so they missed out on the top line. The stock actually didn't do much after the earnings report, and I actually thought our butterfly was going to look really good. So to start with, we were just meandering right around the middle strike of the butterfly that we put together on JP Morgan. But the stock has not behaved since the markets opened. So it dropped precipitously on, not on a ridiculous amount as on a percentage basis for JP Morgan, but on a point basis it did. And now it is trading at $308. We needed the stock to stay above $317.50, which is our bottom strike of our butterfly. Butterfly it still has something in it. So let's run to the Tradier Pro software. And we do still have a few cents in the butterfly. We put it together. We had, let's look at the profit and loss calculator. What if? Let's send it to there, pull this up. So when we put it on, right now it's trading for 34 cents. We were 5 points wide here and 317 to 327. So we got 10 points wide and 5 points wide. We put it on for $3. Well, we paid a little bit more than the $3. We started by looking at a little bit longer term one, and then we came back. I think it was $3.40. I'm guessing. And if we put that on for about that amount, and then if the market would have went higher, it's going to trade for at least $5. And how do we get that? Well, it's the difference between this spread, and I'm pointing to the bottom of the screen right now, all the way down here, 317.50 to 327.50. That's 10 points. And then from 327.50 to 332.50, I didn't want the half point strikes, but the market moved on us. That's 5 points. So the long spread is 10 points. The short spread is 5 points. 10 minus 5 means that if the butterfly goes above our highest strike, it would need to trade for at least $5 at expiration. In the theoretical world, you've got bid-ask spreads that you got to deal with in the real world, but that's where it should have been. It could have been trading at. The market did not. The market went down. We're now trading at 34 cents on this trade, and the market is down a little bit today. Now, you did have an opportunity on the open to try to get out of the trade. I don't know if you would have, mainly because of the after hours action. The JPM just did not do much in the after hours. I really thought it was going to open very close to the strike price. Now, ideally, you would like it to open up and then come back down. So if the stock was trading right around here, and we would like it to come up and be in this range where it has to trade for at least $5 and then drift back and land within the strikes. You only got a few days to that expiration date. So we're looking at the Friday expiration, which was the 16th. Now, the fact that there are a few more days remaining is our friend here. And so we got 34 cents in it. We could close it out. You could have closed it out on Monday and salvaged more. Easily could have closed it out for $1 or $1.50 and cut your loss in half if you would have did it fairly close to the open. And you usually want to, like if you're doing trades based off of earnings and the earnings come out and you see an opportunity, or it's even on the precipice of going negative, you want to get out of the trade. So usually around 10 o'clock, you're going to make some type of move. Now, if the market, let's say the market's hanging right around here, right around the 320, 330, like in this area where you're going to start to get nervous. Okay. So if we put that trade on and the market opens and we see the market dropping towards that level, we just want to get out of the trade because it's based off of earnings. We got a short-term expiration, salvage what we can. The market opens up here, Well, we got a lot of room, because if it comes back, then we can actually make more money if the market actually comes back down. But we're fine if it continues on up. So just keep that in mind when we're doing these type of trades. Now, there is a hedge. There is an alternative. It's not a great alternative, and I've mentioned it a couple of times. And I used to do this a little bit more with the standard butterflies if they would get outside of the range and they didn't behave. So we're in the what if calculator. We got to be in the January expiration. This is where the markets are at. These are our strikes. There's just no premium left now. Now that we're down $2 today, another 1% or 3/4% at 308. Sometimes you can actually close out the short spread, or close out the long spread and leave one of the short spreads on. So like you could sell the 317 and then buy one of the 327s, and then that just leaves you with one short spread. You salvage a little bit, but in here there's just not that much to salvage. You could just close it out and get the 38 cents period on the trade. So sometimes that's an alternative. You sell the most expensive trade that you have, which is the long spread at this point in time, and you hope that the short spread expires worthless. Might have been feasible on Tuesday. It's not feasible right now on Wednesday. So if you'd like me to paint that picture, you say the market goes against you. You didn't close it, but you would have more risk. You have obviously the whiplash risk that the market goes down and then comes flying back, which it can possibly do, mainly because we got other companies announcing earnings. We have Goldman Sachs announcing tomorrow morning before the open, and that's going to be that will have an effect on JP Morgan, just like right now we see Goldman Sachs. When we look at it, I'll just put it over here. Goldman Sachs is trading down today too, and a lot of the financials are there's always, they say in the banks you need about 10 reasons to buy them and you need only one reason to sell them. So Goldman Sachs right now is down 1%, trading down $10 as they head into their earnings report. What we're going to do a trade in Goldman Sachs. So here's what the trade would be, and you might have been able to do it on Tuesday. Is you're going to flip the script and you're going to become neutral to bearish on the trade. And what you would do is this option contract would be sold. And I got to put the open instead of close, but it would be close. And this option contract would be bought. And then you'd remove that leg and it would be exactly that. So right now we could close it out and we could get 38 cents. I'm not saying that we should do it. I'm just telling you what a possible adjustment is. If there were some more premium in the 317, this might be worth doing. Right now there's not. 42 cents. You close the long spread, and then that would leave you short the 327.50 and the 332.50. You'd be short a $5 short call spread, meaning that we want to be bearish, a bear call spread in that instance. So you close the thing that has some value, and then you would leave open the short spread. Now, there are other alternatives, but that could have been an alternative trade if you did believe that JP Morgan would stay below 327.50 by that expiration date on Friday. All right. What's the next trade here? Let's go and look at doing Goldman Sachs, and I have that also loaded up in the what if calculator. So because of a couple of things on JP Morgan, a little bit lower price stock, $308, still expensive. It still makes it a very interesting butterfly trade. I still like the trade, and I still like JP Morgan. The news headlines with the credit cards and the 10%, and I think the market's reacting a lot to just general news, not necessarily just the earnings report. There were some trepidatious statements in the conference call saying things are slowing down a little bit, and that was shown in the revenue. So there was a little bit of both. But if you see the way the market reacted after the earnings report, and the market really didn't start tanking until the actual open. And to me, that had a lot to do with what was going on in Washington and a lot of those comments. Okay. Next. Goldman Sachs. Let's look at Goldman. So now Goldman is double the price, right? Let's send it. Let's send this one to ticket. And let's go look at Goldman in the options chain. And everything's popping today. So we're still in the paper trading platform, which is doing quite well. Okay, so in the Goldman trade, this is the 16th. The market has came down a little bit here. It's kind of bounced a little bit. So yeah, there we go. So 21% chance of it reaching that, 18% chance of going higher, 13% chance of. So because this is a more expensive underlying, and it does matter, the cost of the underlying matters. And especially if you're looking at doing just a one unit or a one contract basis. And that's what we look at a lot here on Options Guy TV. We just try to make things very simple. We look at a one unit or one butterfly, which is a 1 by 2 by 1 butterfly. We're going to look at a skip strike. And what the skip strike will do is it's an alternative to a short spread. I don't like to say that it's an alternative to the butterfly, but it's an alternative to the short call spread. And it's more feasible because they're announcing on a Thursday, because we do have additional risk above and beyond. In JP Morgan, it's what we paid for the butterfly. We opened the wing. We were profitable if we could have got the move to the upside. In Goldman here, we're going to give ourselves a chance for a little bit more profit, but we're trying to capture the gain. And our risk is going to come on a big move to the upside, okay? So here's the butterfly, 42 cents. That's actually not a bad price right there. It was a little bit lower. So the market's kind of moved, but we got a little bit higher probability of it reaching this strike. So I guess the moral to my story is a more expensive underlying announcing on a Thursday as opposed to announcing on a Tuesday. You have all day Thursday because they're going to announce in the morning, and you got all day Friday before the close of the market. 2 days for this option contract to live after the earnings. Implied volatility will come off. We're trading at about 61% implied. Historical vol is about 30, so it should get cut in half. And that will help us just in general with our risk of the trade. And let's run back to the what if calculator, and I'll show you what we're talking about. So this isn't a home run trade. Well, no butterflies are ever really home run trades. You're not just buying an option outright. So in this instance, you have a high probability of success, but not a the probability of making above and beyond what the net credit is fairly low. So to me, this is an alternative to a short call spread. And I think of the butterfly that we did in JP Morgan, once again, not an alternative to a butterfly, but it's an alternative to a long call spread. You can put the trade on, especially around earnings, for a cheaper value than you can if you just bought the long call spread outright. And that gives you less risk if you are incorrect about your forecast. Okay, so let's go here. And we're going to zoom in. So here's where the market is at, 926.93. If the market drifts north and it lands in this area, we can potentially make more on our butterfly. Now, the expiration is Friday, the 16th. This is where the risk is at right now. So if we put this trade on right this second and the market ran up to our middle strike, we would actually be down on the position. What we need to happen in order for us to be up is we need time decay to happen or implied volatility to come in. Both of those things are going to happen after the announcement. So if I'm doing this trade, I'm probably going to wait until the end of the day. I don't mind putting it on right now. It's actually at a decent price. 40 cents isn't bad. It's a decent net credit to the account. And then you're hoping to capture the 40 cents. You have additional risk above and beyond the debit that is paid, and it's created because we are actually embedding a short spread in our butterfly. A standard butterfly, if we were looking at this, would be 5 points wide. 965, 970, 975. It would be a net debit to the account. It would be fairly cheap. We skip the 975 and we buy the 980. That effectively puts in a credit spread from 975 to 980. We would be selling the 975, buying the 980. We're just going to skip it, but that's the way that it would work. Means you would have 5 points of margin that would be held out of your account, minus the net credit receipt. Same situation here. We're getting it done. Well, now it's 25 cents, but 40 cents was looking really good. Markets, yeah, we just dropped another dollar. So that kind of hurt us. We were at $10. I like the 40 cents. We're going to keep it there. Well, got to look at 25 because we got to compare this now. Market moved $1 on us. Okay, so like I said, this is an alternative to the short spread. So let's look at the short spread. If we were to come out and just sell a short spread way out of the money, more than one standard deviation, this is what the short spread would look like. And I'll add this one to the ticket. You got the 970, 975, which I said that's the strike that we would skip. And you have the 980. All right, 5 points wide. Let's see what that's trading for. It's usually about double. Right now it's saying it's minus 20 cents. So you would think about 40 cents or so. So we send it to the ticket. 46 cents. So with a live market, this is the alternative. So here's what we're doing. And I like to think it doesn't necessarily have to be around earnings. Earnings, it's just dramatic. And like I've said many times on Options Guide TV, nothing that we talk about is meant to be recommendations. But when you're doing trades around earnings, you learn so much about option pricing, right? And if you have an expensive underlying that you're doing a trade on and you're thinking about selling short spreads, keep this play in your playbook. Keep the skip strike butterfly in your playbook as an alternative to the short spread. You can do it on the put side too. It's an alternative to just selling the puts outright. And it already embeds your hedge into the trade, right? It already embeds your hedge into the trade. So you look at this, you say, well, I can sell the 95 and buy the 97.50 and buy the 980. I can sell the 975 strike and buy the 980 strike, bring in a net credit of 46 cents, and then have all the risk. If the market starts going against me the entire way up to 975, I got to be nervous. Now, if I do the butterfly in this instance, well, if it's going this direction and time decay is happening, which is big, and implied volatility is coming down, I'm not as nervous. Why? Because I put the hedge in. I'm only going to potentially make half of that. So we can go back and send this one to the what if calculator. I did like it at 40 cents, but let's send it there. Yeah, 20 cents right now. And you're making half of the credit, but you have this benefit that at expiration, this line is ultimately going to morph into this. So here's what's really weird about the skip strike butterfly. If you get really lucky and it lands within the wings, I'm not doing this because I'm thinking I'm going to land within the wings. I'm doing it as an alternative to a short spread. I want to make the net credit. So just have realistic expectations. But it's possible to put this trade on for a net credit and then close it, sell the butterfly for a net credit. Put it on for a net credit, take it off for a net credit. That's very feasible to do if we're close to expiration and we're landing somewhere between the 965 and the 965 and 970. If we land within that range, we could actually put it on for a net credit and sell it for maximum we could trade for is $5. You could actually sell this and bring in $5. That means that you'd get $5.20. Now, very, very unlikely, but that's the possibility. Your risk still is the same. It doesn't kick in until you get to where that skip strike was, which is the 970 range. So our risk on this trade, what was the skip strike? 975. So 970, which would make sense because that's right where we're crossing. So 975 plus the 20 cents is where that is at. Okay. So the market is bouncing again, minus 60. I don't think you get it done for that. I'd toss it in. There you go. I like throwing it in there at 40. I would probably throw it in there at 40 today if I really wanted to do the trade. Your risk is going to be $5, and it only happens if you go more than a 1 standard deviation move. You hit the 975. You got $5 from 975 to 980. That's where your risk kicks in. That's where your loss is. If we look at the trading tab and we look at the deltas, we look at the probabilities, it's saying there is a 13% chance of it breaking the 980 level. Now, probabilities are always you got to take that information with a grain of salt because it's really about the earnings, and the delta doesn't know necessarily where the earnings is at. Implied volatility will hint at it, and it will help, and it will adjust the delta. But obviously, you have a big major unknown event, and I think you want to get long some of these. Ultimately, I think that even Visa and MasterCard, the news that's coming out of Washington, once again, does it happen? Is it a negotiating tool? The market's getting beat up because of it. And I don't think Washington really wants that. They want the banks to thrive. They're removing regulations to make. I think, in other words, I think this is a buying opportunity. So this is a neutral to bearish. It's a schizophrenic, right? In that to start with, it wants the market to go down, but if the market goes up, it's still okay on expiration. It's all about getting to that expiration date if the market is moving up. So ideally, and this is just fun with skip strike butterflies, I love this about options. Ideally, you want to open right about here, about half of the expected move. Now, the expected move, 925.16, so 33 points. Is the expected move. So that's somewhere right around here. It's usually right about where the 20 delta is, or right around 960. That's about where the expected move is at. The 1 standard deviation move is right at our short strike, 970. All right. And that's because the market has actually moved a little bit. And then if it blows through the strikes, which has happened to me, I've done these trades and had to scramble because the market did open above 980. I mean, so that is a feasible, that is a possibility. But there you go. All right. And look at this. Look at all this open interest down here at the 1,000 level. Interesting. The $1 calls, there's a whole bunch of them, it looks like, that are owned in that range. I don't mind Goldman Sachs long term. I don't mind Visa and MasterCard long term at this point in time. They've gotten beaten up a little bit lately too, because once again of the news. I like the financials going into 2026. Something that's AI is going to affect everything, but it's a hedge to me. Financials and healthcare. We're looking at UNH. I like the healthcare space also, but I like the financial space a little bit better. As far as valuations are concerned, the financials don't get the respect that they deserve. You still want to own some AI. I'm just giving you some alternatives. All right. Any other question? I see. Hey, Kurt, good morning. Sorry, I didn't mention that earlier. Did you end up getting out of, did you do the JPM trade? And did you by chance get out on the open? Or did you wait? And if you waited, I would have waited. It was a little befuddling the way the markets reacted after the earnings and then how they opened. Goldman Sachs, JP Morgan. What was my next trade? What if calculator? I think that's it. I think that's all I got for today. And there we are, 11:29. So these are my trades. Oh, nice. Smart. So that's, and honestly, this is one of, I think, about the last 7 open wing butterflies that didn't work out. And JP Morgan was one of those trades. So that's it. That's it for this edition. Definitely paper trade. Oh, and I can actually, I'm in the paper trading platform, which is working a lot better today. Let's send this one just to show that we can. I don't want it to fill. So 34 cents, 1 by 2 by 1. Let's put it in for 20 cents. We're 34. No, we want a higher net credit. We want to go 60 cents. 0.60. And then you want to make sure this says credit. Okay. Send that. Let's see that. There we go. So we can go in here. Oh, and also if we do on JP Morgan, that was what I was thinking, is we might sell a call. And that's where I was. My next trade was going to be to go in and look at selling a call. We'll do that on Friday. We'll look at Friday. Selling a call against this JP Morgan position now that earnings has came out. Let Goldman Sachs do a trade, but that's what was in my head. I was thinking that we should maybe at this point in time sell a call against this JP Morgan position. It's down $1,000. All right. And here's the order inside the grid. All right, everyone. That's it for this edition of Options Guy TV. We'll see you on Friday. We'll look at selling a call against the JP Morgan position. We'll see what happens with the Goldman Sachs trade and see where we land. And that'll be it. See you Friday, 11 a.m. Please click subscribe, give us a thumbs up, and we'll see you Friday.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.